Hello everybody, welcome to DLA Markets. This is Greg, and in this video we are going to talk about Jerome Powell's clown show and how the Fed and he has orchestrated this incredible clown scenario, which was culminated this week in his Fed Congressional testimony, which we're going to talk about. So in this video, we're going to talk about the Fed and the Fed do a Fed policy update. It features Jerome Powell and his continuing clown show. We're going to talk about the Fed and the government's contribution to this three-ring circus that we have going on here with the fight against inflation. We're going to go over Powell's Congressional testimony, which happened this week. We're going to discuss the Fed's many policy mistakes since they stopped keeping interest rates at zero and printing infinite amounts of money. And then we're going to talk about the economic and the market effects of the Fed's mismanagement of the inflation fight. And so without further ado, let's get right into it. All right, so if you remember the last video that I made a week or so ago where I discussed Fed policy, during that speech that Powell gave, he discussed and mentioned disinflation 12 times during that speech. This, of course, gave a market that was already in a bullish sentiment the impression that inflation was cooling, and they started getting all excited about that, and they started to get bullish. The retail investors rushed in, and they started buying meme stocks, and they started buying all these ridiculous stocks. They bid up Tesla again. They started doing all the things that they were doing during the easy money period, and there was a rally. But, as I brought up in the last video, a day or two after, they decided to lower the increase to 25 basis points from 50. Guess what? The labor market came out with a report that showed that the economy produced over 500,000 jobs. This was a complete shock to the market. It was like double what the expectation was, and it made the Fed look particularly stupid. Since then, there's been all kinds of data that's come out that has indicated stronger economic activity and basically has indicated that the labor market and the services economy is still hot. The ADP number came out above expectations. Unemployment is still at 3.4%. And literally every economic piece of data that has come out has indicated that the economy is still strong, particularly in the labor market and also the services sector, which the Fed is focusing on. Okay, so now the dialogue and what's been coming out of the Fed and Powell is that interest rates are going to be higher for longer than people expected. The Fed also keeps talking about we are going to be data dependent. Well, the problem with that is that with the Fed being data dependent, they're not in the driver's seat. They're not taking control of inflation. They're just merely reacting to data that comes out. And we've seen this over the last couple of months. When things seem to be slowing down, they pull back. When things seem to be firm in the economy, and the economy, certain areas of the economy still seem to be hot, then they take a more hawkish stance. This is merely just reacting to what's happening rather than taking an aggressive approach and raising interest rates aggressively, repeatedly, not going down to 50 basis points and 25 basis points, but how about doing a couple more 75 basis points? They already did 4. And then, seeing how things go from there. But they're too wimpy to do that. Powell is not cut out for this kind of job. He's no Volcker, and we've seen that played out again and again. One thing that's important to point out is that inflation is always a monetary phenomenon. This goes back to basic precepts that Milton Friedman laid out back in the 80s, and there is no way that inflation is going to be stamped out any other way than through monetary policy. Okay? Now, the $8 trillion of deficit spending that this idiotic government did during and after COVID, and I have a problem mainly with the $5 trillion that they did after COVID, when the economy was already recovering, that has contributed to the problem that we currently face, and it has exacerbated it and made it more difficult for Powell to get rid of this inflation and bring it down, because you have this push-pull happening where he's raising interest rates, he's draining liquidity by reducing the balance sheet, but at the same time, trillions of dollars from all of these spending bills are coming through, and much of this money has not been spent yet. So this borrowed money is going into the economy, it's stimulating jobs, it's stimulating employment, and it's basically an accelerant when Powell is trying to put his foot on the brake. Now to the testimony this week, the most famous masshole in Congress, Pocahontas, took Powell to task in this exchange, and take a look at it right now.
Thank you, Mr. Chairman. So the Fed has raised interest rates 8 times over the last year in what has been the most extreme rate hike cycle in 40 years. The Fed's goal is to slow inflation, and your tool, raising interest rates, is designed to slow the economy and throw people out of work. So far, you haven't tipped the economy into recession, but you haven't brought inflation entirely under control either. And maybe the reason for that is that other things are also keeping prices high, things you can't fix with high interest rates, things like price gouging and supply chain kinks and a war in Ukraine. But you are determined to continue to raise interest rates, so I want to take a look at where you're headed. In December, the Fed released its projections on the state of the economy under your monetary policy plan. According to the Fed's own report, if you continue raising interest rates as you plan, unemployment will be 4.6% by the end of the year, more than a full point higher than it is today. Chair Powell, if you hit your projections, do you know how many people who are currently working, going about their lives, will lose their jobs?
I don't have that number in front of me. I will say it's not an intended consequence.
But it is, and it's in your report, and that would be about 2 million people who would lose their jobs, people who are working right now, making their mortgages. So, Chair Powell, if you could speak directly to the 2 million hardworking people who have decent jobs today, who you're planning to get fired over the next year, what would you say to them? How would you explain your view that they need to lose their jobs?
I would explain to people more broadly that inflation is extremely high, and it's hurting the working people of this country badly. All of them, not just 2 million of them, but all of them are suffering under high inflation, and we are taking the only measures we have to bring inflation down.
And putting 2 million people out of work is just part of the cost, and they just have to bear it?
Well, will working people be better off if we just walk away from our jobs and inflation remains 5-6%?
Let me ask you about what happens if you do this. Since the end of World War II, there have been 12 times in which the unemployment rate has increased by 1 percentage point within 1 year, exactly what you're aiming to do right now. How many of those times did the U.S. economy avoid falling into a recession?
You know, it's not as black and white as very,
Just
very
looking at
infrequent.
the numbers, it actually is pretty black
Alan
and white.
Blinder's written a book on this, and
There have been 12 times that we've seen a 1-point increase in the unemployment rate in a year. That's exactly what your Fed report has put out as the projection and the plan based on how you're going to keep raising these interest rates. How many times did the economy fail to fall into a recession after doing that? Out of 12 times.
I think the number is 0.
I think the number is 0. That's exactly right. So then the question becomes, we've got 2 million people out of work. Can you stop it at 2 million people? History suggests that the Fed has a terrible track record of containing modest increases in the unemployment rate. Once the economy starts shedding jobs, it's kind of like a runaway train. It is really hard to stop. In fact, in 11 out of the 12 times that the unemployment rate increased by a full percentage point within 1 year, unemployment went on to rise another full percentage point on top of that. If that's what happens this time, we'd be looking at least 3.5 million people who would lose their jobs. So, Chair Powell, if you reach your goal and 2 million people get laid off by the end of this year, and then, just like in 11 out of 12 times that unemployment has risen by a point in a single year, it keeps on rising. And then we've got 2.5 million people out of work. We've got 3 million people who get laid off. We've got 3.5 million people who get laid off. What's your plan?
Well, right now the unemployment rate is 3.4%, which is the lowest in 54 years. And we actually don't think that we need to see a sharp or enormous increase in unemployment to get inflation under control.
I'm looking at your projections. Do you call laying off 2 million people this year not a sharp increase in unemployment?
I would say 4.5%.
Explain that to the 2 million families who are going to be out of work.
We're not targeting any of that. But I would say even 4.5% unemployment is well better than most of the time for the last 75 years.
In other words, you don't have a plan to stop a runaway train if it occurs. Chair Powell, you are gambling with people's lives, and there's a pile of data showing that price gouging and supply chain kinks and the war in Ukraine are driving up prices. You cling to the idea that there's only one solution: lay off millions of workers. We need a Fed that will fight for families, and if you're not going to lead that charge, we need someone at the Fed who will.
Now, obviously, the thing that Pocahontas doesn't realize is that, okay, yeah, by raising interest rates, you might put 2, 3, 4, 5 million people out of work. But if Powell doesn't do that and just leaves interest rates where they are and allows inflation to continue to take hold of the economy and become permanently embedded in the economy will crater on its own and we'll lose 20 million jobs. Okay, if Powell was a little bit brighter, he could have come back at her with that. But, obviously she's just throwing out demagoguery and appealing to the voters and, just staging a play here, kind of like on her soapbox. So there's really no substance to what she was saying anyway. But I thought the most poignant and brilliant interaction between a senator and Powell occurred with John Kennedy, who's the senator from Louisiana. This guy artfully puts the unemployment situation in perspective, and he proved to me that he's one of the smartest guys in Congress.
Thank you, Mr. Chairman. Chairman Powell, thank you for being here. Thank you to you and your team for helping to save the economy during the pandemic meltdown. For what it's worth, I'm generally supportive of the actions of the Fed right now, and I'm not going to ask you today to blame anybody. When Congress spends money, it stimulates the economy, does it not?
Well, it would depend on whether that's funded by tax increases or not. But so if there's a spending that's not accompanied by taxes, would have a net at the margin stimulative effect.
Well, and when Congress borrows money to spend even more. That stimulates the economy even more, does it not?
At the margin, yeah.
Okay. If Congress reduced the rate of growth in its spending and reduced the rate of growth in its debt accumulation, it would make your job easier in reducing inflation, would it not?
I don't think fiscal policy right now is a big factor driving inflation at this moment, but it's absolutely essential that we do slow the pace of growth, particularly for the areas of the budget
All right, let's try to unpack this then. I'm not trying to trick you. You're raising interest rates. You're raising interest rates to slow the economy, are you not?
Yes, to cool the economy off.
And one of the ways you measure your success, other than fluctuation in gross domestic product, is the unemployment rate. Is it not?
Yes, one of the measures.
Okay. So in effect, I'm not being critical. When you're slowing the economy, you're trying to put people out of work. That's your job, is it not?
Not really. We're trying to restore price stability.
No, you're trying to raise
not wages.
You're trying to raise the unemployment rate.
There are a lot of
I know you don't like the phrase, so let me strike it. You're trying to raise the unemployment rate, are you not?
No, we're not trying to raise it. We're trying to realign supply and demand, which could happen through a bunch of channels, like, for example, just job openings.
All right, let me put it another way, okay? The Economist did a wonderful study. They looked at 10 disinflationary periods in America going all the way back to the 1950s. Disinflation is what you're trying to do. It's a slowing in the rate of inflation. Am I right?
Yes.
In other words, prices don't go down, they just don't go up as fast. Deflation is when prices actually go down. You're trying to achieve disinflation, are you not?
Yes, we are.
Okay. Based on history, in the 10 times that we got inflation down, disinflation since the 1950s, in order to reduce inflation by 2%, unemployment had to go up 3.6%. Now, that's history, is it not?
I don't have the numbers in front of me, but yes, the standard has been that there have been recessions and downturns when the Fed has tried to reduce inflation.
Now, right now, the current inflation rate is 6.4%, and the current unemployment rate is 3.4%. Now, if history is right, I'm not asking you to again, blame anybody, but if history is right, unless you get some help, in order to get inflation down from 6.4% to, let's say, 4.4%, and the unemployment rate is going to have to rise to 7% based on history.
That's what the record would say.
Okay. And to get inflation down to 2.2%, based on history, an immutable fact, unemployment would have to go to 10.6%. Would it not?
No, I wouldn't.
That's what the record shows. That's what the history shows.
Yeah, I don't think that kind of a number is at all in play here.
I know you're reluctant to admit it, and you don't want to get in the middle of a policy dispute. But I think it's undeniable. It's undeniable that the only way we're going to get this sticky inflation down is to attack it on the monetary side, which you're doing, and on the fiscal side, which means Congress has got to reduce the rate of growth of spending and reduce the rate of growth of debt accumulation. Now, I get that you don't want to get in the middle of that fight. But the more we help on the fiscal side, the fewer people you're going to have to put out of work. Isn't that a fact?
Please answer.
It could work out that way.
Okay.
Sir?
It could work out that way.
Yes, sir. Thank you.
Thanks.
So I think this very rightly points out that all this talk about, soft landing, no landing, very little damage done to the employment picture, and we're going to get out of this inflation is complete garbage, okay? In my opinion, you're going to have to see the unemployment rate go to 6 or 7% in order to have an effect on inflation in the way he's looking to see. And he's just not being honest with the American public. He rightly, I guess, calculates that the American people cannot really handle the truth in this respect. And the fact is, he's going to have to crush the economy and he's going to have to crush the labor market before you're going to see a meaningful improvement in inflation. Now, the Fed has made so many mistakes that they are practically legendary at this point, okay? The initial mistake, of course, was coming out of the pandemic. He kept interest rates at zero and flooded the market with liquidity and manipulated the bond market to keep interest rates low for about a year and a half to 2 years too long. And that is the main reason why we're in this position. It caused the economy to overheat. It caused the labor market to accelerate. And simultaneously, a lot of people left the labor force due to COVID and the pandemic. And so you have a situation where everything is squeezed and everything is going up in price. Some areas are coming down, but most areas are still very high. That was the first mistake. Now remember, of course, everybody remembers inflation is transitory. That was the second mistake, and it was one of the reasons that caused the first mistake, that misplaced belief. Then he raised rates. He started out slowly with 25 basis points, then 50 basis points. Then he did 4 75 basis point increases. Then he went back to 50. Then most recently he went to 25. So you can see that by doing that and backing off to 25, he made the third mistake, which is going to 25 basis points. And right after that, you see all of this these economic reports that come out and show that the economy is still overheating. And that resulted in now the futures market is showing a probability of 68% chance that they're going to go back to 50 basis points on the next hike in March. The problem I have with this guy Powell is he constantly sugarcoats everything for political purposes. He's not willing to tell these idiot politicians what they have done and what he has done and what needs to be done to bring inflation down. He's sugarcoating everything. He's a people pleaser. He doesn't have the balls that Volcker had or the personality that Volcker had to just give people their bitter pill, tell the truth, because basically these politicians can't handle the truth. And don't forget, we're less than 2 years from a presidential election. And so here we are again. The Fed is in a very bad position. Once again, they are behind the curve, as they have been throughout this entire period. And I believe that the terminal rate, as they say, a Fed funds rate, is going to have to be between 6 and 7%, because that terminal rate has got to be higher than the then prevailing inflation rate in order to make inflation come down. Now, what will that do? That is going to crush the economy, and it's going to crush the labor market, okay? So people have to be prepared for 6, 7, 8, 9, 10% unemployment. And I don't think anybody is thinking like that. Not one person is thinking like that, because the market, both the bond and the stock market, are both still very unrealistic in my view. Okay, so my thoughts on where we are here is the Fed still has a very long way to go. If the Fed is serious about 2% inflation, we're at like 6.4%, mid-sixes, whatever. And those numbers are made up. Those are all cooked numbers, okay? CPI, I call it CP lie, because it's it's a complete bullshit made up number, okay? Let's just be honest. Inflation's much higher than 6.4% right now. So the Fed has a very long way to go. We're going to see a lot of times when the Fed is going to be behind the curve on this. They're going to continue to be behind the curve. And the Fed will not stamp out inflation until it crushes the economy and crushes the labor market. I believe Powell is weak and incompetent, and he ultimately will fold under political pressure, which will cause him to make more mistakes as we go further on down the line. So yes, we're still in a bear market. The market could fall another 20% at least when the recession hits, and that recession is going to hit corporate profits very hard, and the market is still way too high. The S&Ps are like 18 times earnings, which is absurd and ridiculous in an environment where the Fed is doing what it's doing currently. Now, do me a favor and check out this video, which will give you more information that you'll be interested in along the topics discussed in this video. Thank you, and I'll see you on the next video.